Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you an option hedge. So, options were originally brought to the markets for hedging underlying securities. So, a lot of times markets are just playing options for the speculative side of things, but they're a great way to neutralize risk and reduce risk. So I'll show you one example. So this was a trade set up today on TTD Trade Desk. So this was one we've been watching. You see it had a really explosive move here early on the open to the upside and then stalled out. So we were looking to get into this because this is what we call a volatility squeeze. And yesterday on Wednesday had the spike up, then pulled back, but it's still in the squeeze. So looking to get in to see if we could get that to continue, for the momentum to the upside. So right here, when it pulled back into the moving averages on this 15-minute time frame, gave us a signal right there based on our momentum indicators, those two arrows to go long based on an intraday basis. So we did that long trade, and we did this setup as a really defined risk trade as a call debit spread. I'll show you that. So we did a call debit spread for next week's expiration, 14 February, bought the 295, sold the 297, have $2.5 wide spread for $95. So that's the maximum risk on the trade, $95. At expiration next week, if it closes over, the 297.5, this would make $155, which would be a 163% return. So not bad. But then the market started to stall out. So I did not want to sit with this amount of risk. So reduce that risk, almost cut it in half. And I'll show you how. First off, you can see we bought it here and then it stalled out. We were starting getting negative momentum on the shorter term time frame. And so hedged it right about here, okay, right when it was breaking down here, and hedged this, reduced the risk, almost cut it in half with the hedge that we set up using an option spread. So we added to this the vertical credit spread, sold the 14 Feb 20 series, the 312.5, 315, okay, so way up here above this prior spike high, and brought in $40 credit. All right, so that $95 at risk 95 then was reduced down by the $40 credit. So now we reduce this trade to $55, and if it goes out between our short strikes of the call debit spread and the bear call credit spread, Friday the 14th on expiration, this will make $195, which on the risk of 55 gives us a 355% return. So not only did we reduce the risk, almost cut it in half from 95 to 55, but we also increased the return almost 2 times as much by doing this structure, and we've reduced the risk. So it's a really great strategy. This is called a long Condor. Hope this helps. Now, if you'd like to learn more about condors and butterflies and strategies to use those plus defensive strategies and income strategies, join us this Saturday for a free option workshop focusing on butterflies and condors. And you can sign up on this email. Hope to see you there.